Have you ever wondered why some traders seem to have a sixth sense when it comes to option trading? You see, option trading isn't just about crunching numbers and predicting market movements. It's also a game of psychology, a dance of minds. Imagine a grand chessboard where every piece is a different option, every move is a potential trade. Just like chess, option trading requires strategic foresight, but it also involves understanding the mindsets of other players in the market. In option trading, you're not just battling against market trends and financial data, you're also contending with human emotions, biases, and perceptions. It's a delicate balancing act between rational analysis and emotional intuition, between the cold hard facts and the unpredictable tides of human behavior. This psychological aspect of option trading can often be the make or break factor, the difference between a successful trade and a missed opportunity. In the next few minutes, we will take a closer look at the psychological aspects of option trading and how it impacts trading decisions. Let's consider John, an experienced trader who fell prey to FOMO. John's trading journey began on a high note. He had a solid strategy, he was meticulous about his research, and he took calculated risks. But then, something changed. John started hearing about other traders making hefty profits, stories of overnight millionaires, and he began to feel a creeping sensation of being left out. This sensation is what we call the fear of missing out, or FOMO. FOMO is a powerful emotion. It's that nagging feeling that everyone else is getting ahead while you're falling behind. For traders, FOMO can manifest in a variety of ways. It can be the anxiety of missing a market rally, the dread of not investing in a hot stock, or the panic of seeing others profit while you're on the sidelines. In John's case, FOMO began to cloud his judgment. He started making irrational trading decisions, driven by the fear of missing out on potential gains. He deviated from his well-researched strategy, started chasing market trends, and began taking unnecessary risks. His decisions were no longer based on analysis and logic, but on emotion and fear. It's crucial to understand that FOMO can have serious consequences. For John, it led to a series of poor trading decisions that eventually took a toll on his portfolio. He lost money, yes, but more importantly, he lost his confidence, his perspective, and his disciplined approach to trading. FOMO is a formidable adversary for any trader. It can make you feel as if you're always one step behind, always chasing, always missing out. But remember, successful trading isn't about catching every wave, it's about strategic decisions, patience, and discipline. Now, let's be clear. Everyone experiences FOMO at some point. It's a common human emotion, but as traders, we must learn to recognize it, understand it, and manage it. We must remind ourselves that the market will always have opportunities, and we don't have to catch them all. John's story is a classic example of how emotions can steer even the most experienced traders off course. Next, meet Priya, a confident trader who let overconfidence bias get the better of her. You see, Priya is an intelligent and successful businesswoman. She's always been confident about her decisions, whether it's in her personal life or her business ventures. This confidence spilled over into her trading activities, leading her to believe that she was invincible in the options market. But here's the catch. Confidence is a double-edged sword in the world of option trading. While it can inspire bold moves and calculated risks, it can also blur the lines of reality, leading traders like Priya to ignore critical market signals. Priya, brimming with self-assuredness, started to believe that she had a special knack for predicting market trends. She dismissed the advice of seasoned traders and analysts, thinking she knew better. She ignored the red flags, the subtle shifts in market trends, the warning bells that signaled a downturn. Then came the risky trades. Priya believed that she could outsmart the market. She started making trades that were too risky, too ambitious. She believed that her gut instinct was superior to the data and statistics that others relied on. But here's what happened. The market did what it does best. It surprised her. The trends she thought she had deciphered turned out to be illusions. The risky trades she made based on her overconfidence led to substantial losses. This is the peril of overconfidence bias. It's a psychological trap that leads people to overestimate their abilities and underestimate the risks involved. In the world of option trading, where every decision carries a substantial risk, falling into the overconfidence bias can be disastrous. Here's the takeaway. Confidence is crucial in option trading, but so is humility. It's about understanding that the market is complex and unpredictable. It's about respecting the wisdom of those who have navigated its tumultuous waters before. It's about acknowledging that no matter how confident you are, you can't outsmart the market. Priya's case illustrates the dangers of overconfidence in option trading. Now let's shift our focus to Ravi, a trader who succeeded by exercising discipline. Meet Ravi, a seasoned option trader who has seen the peaks and valleys of the stock market, yet he managed to stay afloat and make consistent profits. What's his secret? It's not a complex algorithm or a secret trading strategy, it's discipline. Ravi, like many traders, started his journey with a thrill, a desire to make quick money, but soon he realized that the market is not a casino and he can't rely on luck. It was then that he decided to create a trading plan, a roadmap to navigate the volatile seas of the market. This plan was not just a list of stocks to buy or sell. It was a comprehensive strategy that accounted for different scenarios, potential risks, and exit strategies. But the plan was only half the battle. The real challenge was sticking to it, especially when the market went against him. So, what can we learn from John, Priya, and Ravi's stories? As we delve into the conclusion of our discussion, let's take a moment to reflect on the key points we've addressed throughout this video. First, we explored the psychology behind option trading. We learned that trading isn't just about numbers and charts. It's a mental game where emotions can play a crucial role. This is why understanding the human mind and its tendencies is an essential aspect of successful trading. We then looked at the fear of missing out, or FOMO as it's commonly known. This is a powerful emotion that can lead traders to make impulsive decisions driven by the fear of missing out on potential gains. But as we saw in Priya's story, FOMO can also lead to substantial losses if not managed properly. It's important to remember that not every trade needs to be a winner, and sometimes the best decision is to simply sit out and wait for a better opportunity. Next, we discussed the concept of overconfidence bias, as demonstrated by John's story. Overconfidence can lead traders to underestimate risks and overestimate their own abilities, often resulting in poor decision-making. It's crucial to stay grounded, to understand that trading is a game of probabilities and that no one, no matter how experienced, can predict market movements with absolute certainty. Then, we delved into the power of discipline, using Ravi's story as an example. Discipline in trading means sticking to your trading plan, managing your risks, and not letting emotions drive your decisions. It's about understanding that losses are part of the game and that consistent, disciplined trading can lead to long-term success. These three aspects, emotions, overconfidence bias, and discipline, are intertwined and play a significant role in the psychology of option trading. They can either work for you or against you, depending on how well you understand and manage them. But why is it so important to understand the psychological aspects of option trading? Because by doing so, you can better navigate the ups and downs of the market, make more informed decisions, and ultimately become a more successful trader. Remember, trading is not just about analyzing numbers and predicting market trends. It's also about understanding yourself, your tendencies, your biases, and your emotions. It's about understanding that just as the markets fluctuate, so do our emotions and biases, and that by being aware of these fluctuations, we can make better trading decisions. Understanding the psychology behind option trading can help traders make better decisions and avoid common pitfalls. Remember, successful trading isn't just about numbers, it's also about understanding your own mind. So as we conclude, let's keep these lessons in mind and strive to become not just better traders, but better understanders of ourselves and our minds.